Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking all about the income statement, what it is, why it's important, what the limitations are, and why investors use it so very much in making their decisions. We've also gone through an example and built a multi-step income statement, and it was fun, wasn't it? Then we took a look at some of the condensed statements or simplified statements, such as the single step statement allowed by US GAAP, the condensed statement allowed by US GAAP, and then the IFRS statement. And we talked about some of the differences between US GAAP and IFRS on this important statement. Now it's time to talk about the more advanced things that occur or show up in our income statement. And there's several of them. Let's take a look. A lot of things happen in our business that are not part of normal operations. And remember that really what we want to show in an income statement primarily is the day-to-day operations of our business. So when abnormal things happen, we have to decide, well, what are we going to do with these? They're not really part of our operations. Some of them, like unusual items, we just put in a separate segment. In our example, we looked at rent revenue and interest expense, not day-to-day stuff, but still important parts of our business. If I sell off property, plant, and equipment, I have gains and losses. I don't normally sell off my PP&E, but I do sometimes, and so I want to have those numbers in there somewhere in that income statement. Those unusual items, they end up down at the bottom. We kind of break them out. The other items are a little bit more challenging. We have changes in estimates, changes in principal, discontinued operations, and extraordinary items. Hold it. We got to stop right there. When I first made this video, the information that I presented was absolutely correct. But just a few months ago, FASB issued a brand new standard that changed one of these rules. Now this happens all the time. As FASB goes back and looks at different rules and the cost of different reporting requirements, they'll make changes. Some of it is to improve accuracy, some of it is to reduce cost, and this was a change to reduce cost. You see, FASB decided that these 5 different abnormal transactions were costing companies too much money, especially small companies that don't have large accounting departments or big auditing firms to help them out. So in order to reduce the cost for these companies, FASB got rid of one of these classifications. They got rid of extraordinary items. This brings us in line with IFRS. Under IFRS, you haven't been able to recognize extraordinary items for a long time. Now US GAAP is the same way. They've eliminated it, gotten rid of it. You can't even mention that you think an item is extraordinary anymore in your financial statements. You can say it in the management letter, but the financial statements themselves cannot say that anything is extraordinary. The good news for us is it really simplifies accounting. You see, the rules for what was extraordinary or wasn't extraordinary made it really, I won't say complex. It wasn't a hard calculation or decision to make. It seemed really straightforward. Is it unusual and extraordinary? Great, we can call it extraordinary. The problem was it was difficult to decide, does this specific transaction really qualify under FASB's rules for an extraordinary item? And that was what became difficult. You had to decide internally, you had to convince the auditor, all these different changes had to be made. So instead of what we were looking at with 5 abnormal transactions, we now just have these 4. And that's what we need to talk about as we move forward, are these 4 transactions. The big fight with these transactions was FASB saying we should put all of this on the income statement. They're important events or decisions that you've made. They need to be there. And companies saying no, they shouldn't be on our income statement because they're not usual. They're not going to happen on a regular basis. That's what should be on the income statement, is normal day-to-day continuing operations. So there was this big debate between the 2 groups, FASB and the actual users. And FASB did eventually give in, not completely, but they did make a few changes. And here's what they decided. They decided that unusual items will show up on the income statement as part of normal operations, but will signal that they're unusual by calling them gains and losses instead of revenues and expenses. So revenues and gains are income coming in, expenses and losses are costs going out. But we separate the 2. Revenues and expenses happen all the time. Gains and losses, they're unusual. So still part of the normal income statement, but not included with normal revenues and expenses. Changes in estimates we'll talk about in more detail later, but basically this means that we decided that this piece of equipment that we've depreciated for 5 years now will last us for 8. So our depreciation expense is going to drop. And FASB said, you know what, just change the estimates. improve your numbers, and move forward. So it's actually going to change this year's revenue or expense, and it will just be incorporated as part of those normal operations. What we don't have to do is go back and fix previous years. The next one is discontinued operations. And discontinued operations are parts of the business that we're selling off. And this was where companies won. And FASB agreed. You're right. These don't happen very often. They're never going to happen again because you're selling this business off. So we will let you break this section out of normal operations and put it below the line. And we get this phrase in accounting of things that are above the line and below the line. If it's normal day-to-day, we expect it to recur, maybe not often, but recur, such as the purchase and sale of equipment. It happens on a regular basis, not every day, so it won't be a revenue or an expense, but it happens on a regular basis. So we'll call it a gain or loss to signal that it's unusual, but it still goes above the line as part of these normal operations. Below the line, then, is this discontinued operation that's going away. And we refer to the line formally as income from operations. And the signal there is this is the income that's going to continue, and then what's below the line, below income from continuing operations, is what's going away. And don't you just love how we cleverly labeled that? We've got income from continuing operations from the part we're going to keep, and then a discontinued operations section for the part we're not going to keep. The last part of this are changes in accounting principle. And changes in accounting principle have a unique solution, and we'll talk about that in more detail as we go. But basically what you have to do with changes in principle is go back and fix previous year's financial statements. So in that case, we signal that it's unusual and really not part of normal operations in the fact that we've restated and changed all these different numbers. And we put a note in our financial statements, hey, we had to change all of this because we decided FIFO was better than LIFO for recording inventory. And that's a change in principle. So the most important idea here is that FASB is allowing us to signal that events or transactions are unusual. They're not normal day-to-day stuff. They may happen regularly, so they go above the line, like gains and losses, but they don't happen all the time. So we're not going to clump them in with revenues and expenses. We'll break them out. And we break out each kind a little bit differently and explain it a little bit differently in the notes to the financial statements. So with that, I'm going to turn the time back over to the old me, and we're going to talk through the process of accounting for each of these 4 remaining abnormal transactions. Enjoy. Now, as we get started with this, remember that a change in estimate means I made some kind of an assumption, and now I've had to revise it. I was not right. Examples of this include your bad debt expense. What percentage of people do you think will rip you off? Well, I thought it was 3%. It's really closer to 5%. I better fix that. Another good example is warranty expense. I think 3% are going to bring them back. Turns out only 2% brought them back. I don't have to estimate as high in future years. Those are changes in estimate. And the way that I treat them is I basically use the new method moving forward. I don't go back and change anything in the past. I look at what I've already done and tweak it as I move forward into the future using the new numbers as I go. Let's go ahead and take a look at an example of one of the most common changes, and that's with depreciation. This one happens all the time. Basically what's happened is the company bought a couple years ago a new piece of equipment. This is the example company that we were working on before. They bought a piece of equipment for $10,000. At the time, they figured that piece of equipment would be worth $2,000 after they'd used it for 4 years, and that was as useful as it was going to be. After 4 years, it would be too old and wouldn't do us any more good. Now, though, as they get into the beginning of year 2, which is the year we've been working with, they realized that things haven't changed as quickly as they thought, and they can continue using this piece of equipment for 5 more years. Year 2, 3, 4, 5, and 6. As long as they're willing to sell it at the end of year 6 for only $500 instead of $2,000. Now again, this kind of estimate gets changed all the time, and depreciation is a great example because when you get a brand new piece of equipment, you can't be 100% sure that it's going to last as long as you think, or that you can sell it for as much as you estimated. So as you get better data, as the machine actually works for you and you see what kind of repairs it needs and how often it breaks down, etc., you change your estimates and make them more accurate. And this is what CBDS is doing, is they're making a change and saying, yep, we can use this longer than we thought. So again, the rule with the change in estimate is we just use the new numbers moving forward. So let's take a look at how we would do this. So if you go back to the template for CBDS that we were working on and scroll down a little bit, you'll see a bright green line. And below that line, you'll see a bunch of other information that I put in there so that we can continue working through this example. Get it? We're going to work below the line on these strange items. We get. Well, I thought it was funny. So let's go ahead. We're going to use this template to do two things. First, we're going to use it to do our calculations and see what the journal entries and other adjustments would look like. And then we're going to tweak our income statement so that it includes these adjustments. So let's start out by putting in the information that we know about our equipment. First, we know that we bought it for $10,000. Second, its original salvage value was $2,000. And originally, we assumed, or CBDS assumed, that they could use it for 4 years. With that information, we can now figure out what depreciation expense was in year 0 and year 1, so that we know what they've already done. So let's see. Originally, I had a $10,000 historical cost and a $2,000 salvage value. And my useful life, or this asset's useful life, is 4 years. So let's type that equation in now. 10,000 minus 2,000 divided by 4 gives us our straight line depreciation. So we were assuming or estimating $2,000 of depreciation expense each year. With the depreciation expense, I now need to know how much depreciation expense have we already recognized, because I won't want to recognize it again. So $2,000 a year for 2 years, year 0 and year 1. So I've recorded depreciation expense, or better said, CBDS has, for 2 years, for a total of $4,000 of accumulated depreciation. Now, I need to take a look at my change, because at the beginning of this year, I decided, hey, you can use this longer. Originally, it was worth $10,000, but I've depreciated away already $4,000, and I don't have to depreciate that again or go back and change it, as long as my estimate was made in good faith, which it was. I did use the best information that I had, or CBDS did. So $6,000 is what's left of that original purchase price that hasn't been depreciated yet. I now think I'll sell it for $500, and that will happen 5 years from now, because I think I can use it for 5 more years, including this year. So given these numbers, we can redo our straight line calculation. So 6,000 minus 500 is the amount I want to depreciate over 5 years. So I should be recording depreciation expense of $1,100. Hopefully that all makes sense. We figured out what we had recorded. Since it's been recorded now and I've already depreciated that, it goes away. I can't redepreciate it. So I'm going to move forward with what I do have left, and that's that $6,000. And that gives me my new depreciation expense for this year. Well, the issue that I've got right now, though, is that I've already recorded depreciation expense for the year. I have an income statement and everything. I would have done depreciation as an adjusting entry, done my adjusted trial balance, done my income statement. Oops. I've made a mistake, which means I need to make a correcting entry, and that's what we see down here. So basically, I would have recorded, or did record, $2,000 of depreciation expense in year 2 already. That's what's in my income statement that I made a few minutes ago. What I should have recorded, though, was $1,100 of depreciation expense. Now I need to make a correction, because I need to get from the $2,000 that I did recognize to the $1,100 that I should have recognized. So in this case, my depreciation expense is too high. If I want to drop depreciation expense, I'm going to credit it. Also, I recognize too much accumulated depreciation. Accumulated depreciation is a contra asset. It's got a credit balance. I credited it in my actual entry there on top. Now I need to debit it to drop it down. And the amount will be the 2,000 minus the 1,100. That's my change. So I actually need to make this correcting entry for depreciation, if I can spell. Yeah, I'm going to make that italic so it sets it off. With that, we're going to pause here because we've gone kind of long in this segment. When we come back, I want to show you how this fits into our income statement so that we can keep moving forward, actually using this information to tweak our numbers. We'll see you then.